Welcome to the Probasco podcast. I am Claudia Williamson, the Scott L. Probasco Distinguished Chair Free Enterprise and Professor of Economics at the University of Tennessee at Chattanooga. I'm joined today with Dr. Will Luther, an Associate Professor of Economics at Florida Atlantic University, Director of the American Institute for Economic Research Sound Money Project, and an adjunct scholar with the Cato Institute's Center for Monetary and Financial Alternatives. Will has published more than 35 academic journal articles on macro topics ranging from monetary policy, Bitcoin, business cycles, and economic growth. His research is featured in The Economist, NPR, Wall Street Journal, Time, Forbes, Fortune, and many other impressive outlets. Will, welcome to the first episode of the Probasco podcast.
It's my pleasure to be here.
Thank you. All right, we're just going to jump into our first topic and discuss Bitcoin. And so could you please just describe what is Bitcoin and give some of the history and background?
So Bitcoin is a cryptocurrency, a digital currency, so you can make and receive payments on the internet. But it's also important to recognize that it's a payment protocol. If you think about making a transaction out of your bank account, maybe you swipe your debit card or you write a check if you're old like me. And what your bank does there is first they certify that you actually have the funds to make the payment. Then they debit your account and they credit the account of whoever you're paying. Now, if you're dealing with someone at the same bank, another customer of the bank, this all happens in-house. If you're dealing with a customer of some other bank, then this happens one layer up at the interbank payment system. But fundamentally, this has to happen when you have a digital payment. One person's account has to be debited, and the other person's account has to be credited. That's how the funds are actually transferred. Now, with traditional digital payments, like that checking account, you have to rely on a trusted third party, like a bank, to debit one account and credit another. The novelty of Bitcoin is that it does this without relying on some trusted third party. Instead, it uses the network as a whole to process this transaction. So you can think about Bitcoin as being both a cryptocurrency and a protocol that updates a shared ledger or a blockchain.
Okay. So then, given that we already have a system in place, as you were describing, with traditional banks and traditional currency, why do we need Bitcoin?
Well, for many transactions, we don't.
Okay.
For many transactions, we're perfectly content using the digital payments that we have. But there are some features of Bitcoin that make it especially useful in some subset of transactions. So, for example, if you open up a bank account, your bank has to comply with Know Your Customer laws. So you have to provide a lot of identifying information to open up that bank account. With Bitcoin, you can just create a public address, and then anyone can send you funds, and you don't actually have to reveal your identity to have that account in order to be able to receive funds. And similarly, you can then send funds from that account, Bitcoin, without telling anyone who you are. So for transactions where you might want some financial privacy, having access to a payment technology like Bitcoin is very useful. At the same time, if you're going to be making international payments, our traditional payments, they're just not designed very well to do that.
Okay.
If you're in America, you're using the American banking system, and so you need to connect to the banking system of some other country. You might use a transfer service like Western Union to send funds, and to do that, you're going to incur some fairly significant fees. On the other hand, cryptocurrencies like Bitcoin, they're really designed for a global market. So you can transfer value just as cheaply from here to Knoxville as you could from here to Nepal. It's really no difference in terms of distance from the perspective of the Bitcoin protocol.
Okay, so one of the criticisms that we find and we hear with Bitcoin or other cryptocurrencies is that it's helping fund illegal activities. It's helping to fund criminal activity or on the dark web or even human or drug trafficking. And so what is your response to that? Because you did mention one of the benefits is that you can keep kind of the transactions in secret.
That's right. Cryptocurrencies like Bitcoin tend to offer a higher degree of financial privacy, and there's no denying that some people use that financial privacy to engage in illicit activities, to make payments for, say, illicit goods or services, or to make perfectly legal transactions, but to do so without reporting their income and therefore evading the taxes on those gains. So that happens.
Okay.
Right? But we have to ask, to what extent? To what extent is this happening? If you think about big criminal enterprises, it's not like they suddenly existed in 2009 with the launch of Bitcoin. We have a long history of criminals making transactions, large transactions in many cases, transactions that go across borders. Criminal enterprises already have access to some pretty good payment mechanisms for making these illicit transactions. Now, is Bitcoin better at making some of those transactions than the previous technologies that they were using? Certainly in some cases that's true, but not in all cases. Meanwhile, there are a lot of transactions that Bitcoin facilitates that most people who are interested in promoting freedom, for example, would be perfectly content to see those transactions take place, even if they happen to be illegal. So, for example, if you were in Venezuela and you wanted to support the opposition party, I would discourage you from using your bank accounts to do that, right? Because
Yes.
you're putting your life at risk. You're putting your family members' lives at risk. Now, what kind of transaction are you making there? Well, you're supporting a protest or providing some funds for the opposition to be able to circulate a newsletter. Most of us in countries like the U.S. don't look at these activities as being illegal.
Okay.
But in some places around the world, they are. And in those places, we would like for people to have access to a payment technology that allows those transactions to be made.
I think that helps to clarify in terms of usage and the role that Bitcoin can play to facilitate many transactions. But I do think it is important that the way that you discuss that it can be used by others who maybe we would prefer those transactions aren't going to take place. But I do think it's important for us to realize, as you were mentioning, those transactions have taken place well before Bitcoin.
That's right. Yeah, and if we're thinking about crime and tax evasion, the currency of choice for crime and tax evasion is the U.S. dollar, right?
Yes,
The U.S. government prints $100 bills. There are more $100 bills in circulation than by value than any other denomination. And that's not a coincidence, right? Now, it's partly because people around the world are confident to hold their wealth in U.S. dollars, but certainly those U.S. dollars are also being used by criminals and folks engaged in tax evasion. But when we look at the dollar, a payment technology that we're very familiar with, and we've used those cash dollars to make perfectly mundane transactions. Most of us don't look at cash and immediately think crime
Right.
tax evasion, right? We think mundane transactions.
Yeah, exactly.
And I suspect that in the cryptocurrency space, the share of transactions that are being used for relatively mundane transactions is much bigger than the share going to criminal enterprises.
Yeah, that's interesting. So picking up the role of the U.S. dollar in general for these mundane transactions, we call this money or fiat money. And so can you discuss the similarities and differences between classifying using the kind of traditional economic definition of money, compare that with, say, the U.S. dollar with Bitcoin?
So economists define a money as a commonly accepted medium of exchange. And so it's relatively straightforward to determine whether an item is money. You just need to figure out if it's commonly accepted as a medium of exchange. Now, that is, of course, a very difficult thing to do because the definition is pretty vague. How common is common? Typically, I tell my students, if you can walk into the local 7-Eleven and be pretty confident that the clerk will accept the item that you're planning to use as a medium of exchange, then that item is money. But it turns out that an item can be both money and not money at the same time.
Okay.
So let me give you some examples of that. Here we are in Chattanooga. I'm using the dollar. I assume you're using the dollar as well. I expect that any convenience store that I pop into, they will happily accept my dollars. They probably won't accept euro, right? That would be unlikely if they would accept euro. Maybe, right? Yeah. Maybe we find someone who's getting ready to go on a trip to France, and so they're happy to convert the price of my goods to euros and accept euros. But it would be unlikely. Of course, if we were in France, right, we would be in exactly the opposite situation where almost everything, almost everyone would be willing to accept euros, and many people would not be willing to accept dollars. And so here we have a case where the dollar is money and the dollar is not money at the same time, and the euro is money and the euro is not money at the same time. And the relevant question is over what range? So for the euro, you can be reasonably confident if you're in Europe that it's going to function as money. The dollar it's a bit different because it's the international reserve currency. So not only does it function as money in the U.S., but also in at least in major cities and a lot of other countries around the world.
Okay, so how would you respond to those who say that Bitcoin is not exactly operating like money because it doesn't have a store of value, or it's more based on speculation, or looked at now as more of a potential investment?
So if you take a basic money and banking class, the first two things an instructor will say is that money is a commonly accepted medium of exchange, and it has three characteristics. It's a medium of exchange, a store of value, and a unit of account. But we don't want to confuse the common or typical characteristics of a money with the definition of money.
Okay.
So the medium of exchange characteristic, that's a necessary condition. It's in the definition of money.
Right, exactly.
It's not a sufficient condition because it also has to be a commonly accepted medium of exchange. The store of value, this is, in some sense, it's trivial. Because to say that an item is a store of value is just to say that it's an asset, that it has some positive price. It's expected to have some positive price in the future. And so this doesn't really rule out anything, right? Everything with a positive price is an asset. Typically what people mean when they say that Bitcoin is not a store of value is they mean that it's not a good store of value, that its purchasing power fluctuates a lot. Which is true. The purchasing power does fluctuate a lot. But one, the characteristic is not that it be a good store of value. It's that it be a store of value. And two, that characteristic is trivial, right? Everything meets that characteristic.
Okay.
And the third characteristic is that Bitcoin is a unit, or is that a money is a unit of account. So folks will say, well, we don't price goods and services in Bitcoin. No one is doing their accounting in Bitcoin. And so Bitcoin doesn't function as a unit of account. Therefore, it's not a money. But again, we don't want to confuse those typical characteristics of a money or typical functions of a money with the definition of money. We can actually find other examples of assets that are clearly functioning as money, that is, as a commonly accepted medium of exchange, but those assets are not functioning as a unit of account. My favorite example comes from Brazil. So Brazil, when they were dealing with hyperinflation, they had a currency, which I'm going to pronounce this very poorly because my Portuguese is rusty to say the least, the Cruzeiro.
Okay.
And prices in Cruzeiro was, they were increasing rapidly because of the hyperinflation. And they got this idea to introduce this this new unit of account, which was called the Unidad Real Valor, the unit of real value, the URV. And you could price your goods and services, if you were a merchant, in terms of the URV. And every day the central bank would announce the exchange rate between the URV and the Cruciero. But absolutely no one used the URV as a medium of exchange. And I'm confident that absolutely no one used the URV as a medium of exchange because it did not exist. It was just a unit of account.
Okay.
Right? And so if you were in Brazil at that time and you went into a shop to make a transaction, you would see prices posted in URV, this fictional unit of account, and then you would get up to the till, and the merchant would then tell you what the exchange rate is, multiplied by the URV price to determine how many Cruciero you would have to hand over. But the actual asset that you're using as a medium of exchange is not the URV, it's the Cruciero.
Okay.
And so the Cruciero was a money, even though it wasn't functioning as a unit of account.
Okay, that's interesting. That's a great example. So one of the other kind of issues or maybe misconceptions with Bitcoin is related to how you get Bitcoin or how you mine it, and then also how that relates to its value. So can you discuss the kind of when Bitcoin first came about and the overall understanding and project of that kind of increase or mining Bitcoin and how that works?
Sure. Well, I mentioned earlier that Bitcoin is a ledger and a protocol for updating that ledger. And the way that actually works is that if I make a Bitcoin transaction, my transaction gets bundled together with all the other transactions that have been recently made, and all of the computers that are running the Bitcoin protocol begin racing to confirm this batch of transactions. That is to update our shared ledger. And because Bitcoin employs what we call a proof of work mechanism, it's costly to update this ledger. You have to run your machine. You're going to have to use electricity. And so in order to encourage people to incur those costs, the entity, the computer that is the first to process a batch of transactions is rewarded some new Bitcoin that never existed before.
Okay.
And so this is how Bitcoin is created.
Okay.
Because this looks a lot like, at least there's a clear analogy here to gold mining. The folks who are processing transactions and therefore getting this new Bitcoin are often referred to as miners. Okay. It would probably be a little clearer if we called them transaction processors or ledger maintainers, but we don't. We call them miners. And so this is how new Bitcoin is created.
And then how does that relate to, we think about the increase in value, or you even have mentioned how much Bitcoin fluctuates in value. So can you kind of hypothesize or explain somewhat the run-ups or the big speculations that we've seen, and how that relates to really how we can understand Bitcoin's value?
Sure. So, in thinking about the costs of production, many folks, even many folks who are keenly interested in Bitcoin, will argue that Bitcoin is valuable because it's costly to produce.
Okay.
But there are lots of things that are costly to produce that aren't worth anything. Right.
Yeah.
And we try not to produce those things. And so the fact that Bitcoin is costly to produce is not the source of its value. In fact, the relationship goes exactly the opposite way. So there is some demand for Bitcoin. There is some use for Bitcoin. And those demand uses, right, those uses give Bitcoin value. People are willing to hand over valuable goods and services for Bitcoin. And as a consequence of that, individuals are going to be willing to incur costs to get Bitcoin, that is, to mine that Bitcoin. And so there is a relationship between the cost and the value. But it's not that the cost is causing Bitcoin to be valuable. Rather, it's that because Bitcoin is valuable, that causes people to incur costs to get it.
Yes, I think that helps to clarify a lot of the misconceptions and viewing it more as purely on speculation. There is individuals that truly do value it.
That's right. It's useful to do some things.
It's useful to them, and so they were willing to incur costs. So I think that's a great point to make. Related to that is one that I've heard now and is brought up to me about the environmental cost. So you mentioned the electricity cost. So what is your response to those who are concerned about the environment, and now especially in the last year or so with Bitcoin being valued more heavily, that there's this kind of negative externality that we're getting these spillover effects on the environment?
So I guess I'll have to answer this question in stages.
Okay.
Right. So first, let's acknowledge the truth of this claim that we do use real resources to confirm transactions with Bitcoin. And when we use those real resources, then that's going to be energy used. Perhaps there are some emissions involved with that as well. So there is an environmental cost here. There's no denying that. And there is also a reason to believe that the costs that are incurred, the environmental costs that are incurred, are larger for Bitcoin now than are necessary to make this system work. I mentioned that Bitcoin employs a proof of work mechanism. There are other mechanisms like a proof of stake mechanism that have a lower resource cost. But the basic idea is that at the moment, if you process a batch of transactions, you're rewarded some new Bitcoin, and that amount of Bitcoin is exogenously determined. It's set in the Bitcoin code.
Okay.
Now that reward is cut in half roughly every 4 years, and eventually it falls to zero.
Okay.
And at that point, miners will be entirely funded by transaction fees. And you have to ask yourself, how much will people be willing to pay in order to make a Bitcoin transaction? And I don't know the dollar amount, but I do know that it won't be more than they would have to pay to make that transaction with the next best alternative payment mechanism. So there will be in the future, there will be a maximum willingness to pay that is determined by your next best alternative. And at that point, we won't be incurring any more resource costs to make transactions with Bitcoin than we would in our next best alternative. Now, that still leaves us with the present day, where we do have this excess cost to process transactions, which is a product of the way Bitcoin is designed. But that said, miners, they want to maximize their profits. They can't change the amount of Bitcoin rewards that are available, but they can take steps to lower their cost. And so they do that. They look for ways of using energy that would otherwise be wasted. They use renewable energies where those are cheap to do so. And so the environmental cost, it's there, but there's a built-in incentive to minimize that to the extent that's possible. The last thing I'll say about this is that it's easy to look at Bitcoin and see that costs are being incurred and say, we shouldn't do this because it's so costly. But we need to make a relevant comparison. Compared to what? Our dollar-based system is also costly.
That's right. Yeah.
And Bitcoin is not just like the physical cash that's in circulation. It's also a payment system. So when you're thinking about the costs of processing transactions in dollars, you have to think about all of those banks that are using electricity to run their websites and to facilitate transactions, my computer running to log on to that website and queue up and an electronic funds transfer. There are a lot of costs there as well. And there are also costs in dealing with our monetary system, the Federal Reserve System. We incur a lot of costs to try and figure out what the Fed is going to do with the money supply, how high inflation is going to be in the future. We have scores of people who are watching the Fed. Mm-hmm. All of those resources, those labor hours, could be used to produce other valuable goods and services. So in a sense, that is, in the sense that there might be some better way of running a monetary system, in that sense, those labor hours are just wasted. We could be using that labor for something else.
That's an excellent point, and one that often gets minimized in conversations like this, that we aren't thinking in terms of compared to what is the alternative, or if we're not using Bitcoin, what are we using? And usually, as you've mentioned, if you're in the US or even in other countries, it's going to be the dollar. And so I think that leads into one of the other issues I wanted to discuss. You brought up the Fed. You brought up the, right now, watching to see what the Fed is doing. Is inflation real? Is it transitory, as the Fed is saying? So to kind of discuss where you think we are and then how Bitcoin can play into that. And what I mean is, do you see Bitcoin as being a complement to current, the U.S. dollar or other fiat currencies, or do you see it as a competing system where individuals, for example, if you really are fearing high rates of inflation, you would turn to Bitcoin to try to avoid those additional costs from, say, Fed policy that is going down a track of inflation?
So if you just look at the headline rates for the PCE price index, that's the Federal Reserve's preferred measure.
Okay.
For August, the year-on-year inflation rate was 4.3%. Historically, that rate seems high.
Mm-hmm.
If you go back, from 2012 to January 2020, inflation, PCE-PI inflation averaged like 1.43% year on year.
Wow!
So that's a big difference.
That's a big difference.
But there are a couple things we should keep in mind here.
Okay.
First, we are still having a pretty significant macroeconomic event, right? The pandemic. And if we go back a year ago, the price level was actually growing slower than was projected. And so part of the reason why the rate is so high today is because we're growing from a low base. That is, it's high today because it was so low a year ago. The Fed has adopted an average inflation target. And if it's following its average inflation target, then a period of low inflation will be followed by a period of high inflation, but that will be temporary, just until the price level has caught up to where it otherwise would have been. And there are reasons why this is desirable. It makes it much easier for us to predict the price level well into the future, because we know that any error that's made today will be offset tomorrow. Now, that said, the Fed has arguably overcorrected.
Okay.
That is, the 4.3% that we have gotten over the last year was more than enough to catch up to where the price level otherwise would have been. And actually today, I think we're something like 1.6 percentage points above that price level trajectory. So so inflation, by that metric is high. The question is whether or not that is policy induced or supply induced.
Okay.
If it's supply induced, when the economy began opening up again, and people went back, and they're still going back, but when they began going back to their typical production, there were some supply constraints. It turns out that if you don't chop down any trees for 2 months, that a year later there's not a lot of lumber in the Home Depot. And if you don't make chips, computer chips, then a year later you're going to have a hard time producing automobiles because you don't have the computer chips necessary to make those automobiles. So those supply constraints associated with that reopening causes prices to rise. So it's possible that the reason that we're above that price level trajectory at present is because of the high the supply constraints inducing high prices. Now, if that's the case, then what we should expect the Fed to do over the coming months as those supply constraints work their way out is to see that inflation back down to trend. And so not only would we not have, say, 2% inflation over the next year, which is the Fed's target, but we'd actually have something a little less than 2% so that we can catch up to that long-run 2% trajectory. Whether that will happen, of course, depends on how committed the Fed is to its average inflation target. And I think there are reasons to doubt the Fed's credibility there.
Okay, so that's where I was headed, is getting more into, let's talk about how confident you are in the Fed's ability to overcorrect or undercorrect its targeted goal of 2% inflation. So just even being able to manipulate it, but then even if they know how, if they would be willing to do so, because there are real costs to inflation, and at times politicians maybe don't want to face those costs. And so if you could give me some of your thoughts on that.
I think those two questions are the important questions to ask. So let's talk about just the technology of monetary policy first. Can the Fed do this? Can it produce an average rate of inflation of 2% over the medium to long term? And I have very little doubts that it can do this.
Okay.
It has the tools to do this. Here are two tools that folks should keep in mind. The first is that the Fed has a very large balance sheet at this point. Yes, it has created a huge increase in the monetary base, beginning with the Great Recession, but certainly over the last year as well. But when it increases the monetary base, it also purchases financial assets, and it's holding those financial assets. So at any point in the future, it has the ability to sell those financial assets and take that money right back out of circulation. And so if it does that, it can put a handle on, get a handle on inflation. It also has this new policy lever that it got arguably without the full authorization of Congress, but that's another story. But it got it in 2008, October 2008. That's the ability to pay interest on reserves. Most of the money that we use for transactions is money that is created by the banking system. And by raising the rate that the Fed pays on reserves, it can actually reduce the extent to which the private banking system creates money. Another way of thinking about this is that it reduces the money multiplier if you've had a basic macroeconomics course. And so it can pay a higher rate of interest on reserves. So with those two tools, and the Fed has others, but with those two tools, I think the Fed is capable of targeting inflation at 2% on average over the long term. The harder question to answer is whether it's willing to do so. So let's think about those two mechanisms.
Okay.
So if the Fed is selling its Treasury holdings, then the Fed is not holding its Treasury holdings. This is necessarily true.
Right.
When the Fed holds Treasuries, the U.S. Treasury pays the Fed because the Fed's holding the Treasuries, and then the Fed turns around and remits its revenues right back to the Treasury. If the Fed instead sells those Treasuries because it's worried about inflation, now the public is holding those Treasuries. The U.S. Treasury still has to pay those bondholders, but if you and I are holding those Treasuries, we don't remit our revenues back to the Treasury.
Right.
So this is an expense for the U.S. government. It's a costly proposition. Okay, what about raising interest on reserves? Well, if the Fed pays a higher interest on reserves to banks to dissuade them from lending out their reserves and creating money, then it is going to incur an additional cost, right? So its revenues after cost are going to be lower, which means it has less to remit to the Treasury. And so we see both of these policy tools result in lower revenues being remitted to the Treasury. A lot of folks are talking about the debt right now, right? Congress looks on track to have record deficit levels again here. I'm sure that Janet Yellen and the folks at the Treasury are very keen to see their interest expenses remain low. If inflation starts to pick up and the Fed has to pay a higher interest on reserves or sell some of its treasuries, that's not good from the government's perspective. So no doubt there would be some pressure to perhaps not do as much as the Fed could do to keep inflation in line.
So if you've also taken a basic macro or monetary and banking class, the Fed's supposed to be independent. That is what we teach. The Fed is independent. So how do you see that currently in terms of what are ways that maybe there could be political pressure on the Fed to not rein in inflation as much due to the incentives you were just discussing?
Well, with all due respect to my colleagues in the central banking independence literature, there's a little bit of an error there in that common argument. The common argument is an independent central bank produces better monetary policy. The Fed has produced reasonably good monetary policy. Therefore, the Fed is independent. Now, if you just write that out, it's pretty clear that doesn't follow.
Right.
The Fed isn't independent, and it has never been independent. Under Richard Nixon, there was pressure on Arthur Burns to goose the economy in the run-up to the election. Lyndon Johnson literally strong-armed the chair of the Fed at the time to produce looser monetary policy. If we go back to the previous administration, there were many tweets referencing Jay Powell. President Trump really wanted Powell to be accommodative, to produce loose monetary policy and make the economy look good. And at the moment, you have the Biden administration saying, well, do we really want to reappoint Jay Powell? Well, maybe if he does what we would like for him to do, or perhaps we should replace him with someone who's going to be a little more friendly to our administration. So I think that there is very little evidence that we have an independent central bank in the U.S. And so certainly we need to worry about that political pressure.
So then let's kind of flip that question. When we have seen Fed chairmen really rein in inflation, and so in the 70s and 80s during, so the Volcker era, and there, Americans were facing the cost of that transition to really get the, inflation under control. Politically, that would not have been popular. And so
it was incredibly unpopular.
So then how do you...
folks, construction workers were sending 2x4s to the Eccles building for tall Paul Volcker. They were not happy.
They're not going to be happy about it. So then how do we... Let's say we get in a situation, or maybe we're in that situation now, where we're going to have a Volcker-type person. How do you do that politically?
Well, if you think about what I said earlier, that the Fed is not independent, this raises a big question, right? If the Fed is not independent, then why isn't monetary policy in the U.S. much worse?
Right. That's a great question. That's a great question.
Earlier this week, Venezuela announced that it's introducing just lop off 6 zeros.
Just take 6 of them off.
And it's not the first time that they've done this. It's not the second time that they have done this, right?
Wow.
So why don't we get that kind of monetary policy in the U.S.? And the answer, I think, is that we, even though we lack those formal institutional constraints on the Fed, and in particular the political meddling with the Fed, we lack those formal constraints, but we do still have informal constraints. So when President Trump was putting pressure on Jay Powell, a lot of folks in the media were saying, don't do that. And today, when President Biden is saying that he is thinking about whether or not to reappoint Jay Powell, the American people, they're saying we're concerned about inflation. Focus on that. Keep that under control. And those broader institutional mechanisms, those beliefs about what is appropriate for the Fed to do, how monetary policy should be conducted, in a broad sense, right? The typical American isn't saying, well, the Federal Reserve should raise its federal funds rate by 10 basis points, right? It's not like that, right? But it's that when we get bad monetary policy, we can see it. And as a consequence of that, as a consequence of the public being willing to punish elected officials when monetary policy is bad, but those elected officials, they have a bit of an incentive not to use some of the formal power that they have to push the Fed to do things that perhaps it shouldn't do. So we have examples of what I would describe as going over the line, but at the same time we have some constraints that keep that from being so much worse than it might otherwise be.
Okay.
Informal constraints.
So that's a pretty optimistic take, I think, but I don't know. We'll see how, right? We're going to see how these inflation issues and what the Fed decides to do shakes out. So one other issue I'd like to turn to is the gold standard. And I know you have some research on this, and I think it definitely relates to the monetary issues we've been discussing with monetary policy and inflation, and then also, the use of Bitcoin. And so just explain a little bit about how the gold standard actually worked and some of its merits, because I think now what we hear is it's, so antiquated. Why are we even talking, or why do we need to talk about the gold standard? And, there's no way we could return to it. So just give us some of your thoughts on that.
Well, if we go back to some of the things we were saying about the Fed and Bitcoin, we said that the purchasing power of Bitcoin is very volatile. And it's volatile because when the demand to hold Bitcoin changes, there's no adjustment in the supply of Bitcoin. It just follows a pre-programmed supply trajectory. And when we were talking about the Fed, we're very concerned, right? What will the Fed do? What will Jay Powell's next monetary policy move be? So here we have a totally unanchored supply. It's completely up to the discretion of the central bank. And these are really like two extremes. With Bitcoin, we have a fixed supply. It follows this trajectory. It cannot deviate from that. And with our current dollar, we have this discretionary supply. It can fluctuate as much or as little as the central bank would like. And I see the gold standard as a sort of a compromise between the two. Under the gold standard, we had a flexible supply of money, and it was flexible in a very predictable way. So if there was an increase in the demand for gold coins, the purchasing power of gold goes up. And in response to that increase in the purchasing power, miners have an incentive to dig a little deeper or to explore some less productive ground. And as a consequence of that, more gold comes to market. It goes to the mint, it gets coined, the supply of money increases, and it drives that purchasing power back down. When do they stop bringing additional gold to the mint? Well, when the purchasing power is back down to its long-run level. And so if you look over long periods of time on the gold standard, you see that the purchasing power of gold was pretty stable. A dollar defined as gold had roughly the same purchasing power at the beginning of the gold standard as it did at the end of the gold standard. And this has some nice side effects. If you're engaged in long-term contracting, for example, maybe you're a railroad, you're putting in a railroad that's going to last 100 years, you might want to finance this, you're borrowing for that project over the course of the project. What we see under the gold standard is that railroads would willingly issue 100-year bonds, and people would buy them.
Wow.
Today, you never see a 100-year bond.
Right.
They come up occasionally, but usually it's a novelty. So Disney issued a Sleeping Beauty bond that was, lasted 100 years. But, we have no idea what the purchasing power of the dollar is going to look like in 100 years under our current monetary system. And so it's really difficult to convince someone to enter into a long-term nominal debt contract. But that just wasn't the case under the gold standard. People entered those kind of contracts. So that predictable mechanism is very useful for anchoring long-run expectations in a way that neither Bitcoin nor our current Fed-managed dollar can do.
So, in your academic scholarly opinion, is it something that we should talk about more in terms of reverting back to a system like the gold standard?
So I'm personally skeptical that returning to a gold standard would be beneficial.
Okay.
One reason I'm skeptical is because that gold standard, it depended crucially on our beliefs about the gold standard. And one of our beliefs at the time is that in 100 years, we would still be on the gold standard.
Right.
And so our confidence in that system, that in its persistence, made it possible for us to have those long-run expectations of the purchasing power of the dollar under the gold standard that I think it would be impossible to go back to today. Today, if we were to revert to a gold standard, we would be on a gold standard that everyone would know we could abandon.
Yeah, that's right. That's an excellent point.
If push came to shove, right? Because Nixon did that.
Yeah,
right?
We already did it. So.
And so I just don't think it would be as credible an anchor as it was in the past. That said, I think that we can learn a lot about how that system functioned in practice, the ways in which it worked well, the ways in which it worked poorly, and use that knowledge to conduct monetary policy more effectively today.
Yeah, I think that's a great point. All right. Any other issues or things you want to bring up from your research in this kind of macro space that you have just been kind of ahead of the game researching Bitcoin before most people even knew what Bitcoin was, and your work again on the gold standard and the Fed has just been amazing?
Well, I'll say as a macroeconomist, right, when I shouldn't say this, but I've already started.
That's right. You've got to. You got to finish.
When the world weeps, we rejoice. Whenever there's a big economic downturn, we think, oh, people are interested in macroeconomics again. Whenever there's a risk of high inflation, we think, oh, I can explain.
You're relevant again.
Process, right? Right now we're dealing with a huge economic shock, the pandemic. There have been a host of political responses to this pandemic, some good, some bad, some mixed, and it's not really clear how all this is going to shake out. Maybe inflation will come back down. Maybe the deficits will come back down, or maybe not. Right, and I think that the thing that I'm most concerned about going forward is actually at the intersection of politics and economics. I'm not a big fan of politics, so if you think about the debate that's been happening over the last year between folks on the left and folks on the right, the folks on the left were very keen to engage in big fiscal expenditures to alleviate the difficulties associated with the pandemic.
Right.
And many folks on the right warned that this would cause high inflation. And I think both sides are wrong here.
Okay.
Right. The right is wrong that this is necessarily going to cause significant inflation, because, as we discussed earlier, the Fed has tools to keep that under control. The left is wrong to think that if there's not inflation, then all of this is costless.
That's yes, yeah.
And so my concern, it's not costless because we're using real resources, right? If the government directs more real resources in the economy, then there are fewer real resources for the private sector to direct. Economists sometimes refer to this as crowding out. So my concern is that, sometime in the next 6 months or a year, the Fed will have kept inflation under control. And folks on the left will say, look, we told you, we can have these big fiscal expenditures and they're costless because we didn't get inflation. And so not only can we do this in response to a severe economic shock, right, like the pandemic, but we can also run these deficits as a normal course of things. And if we do that, they're right that we can do this without producing significant inflation. The Fed can keep inflation under control. But there is a cost, and that cost would be the real resource cost of those expenditures, the slower economic growth, the slower improvement in the living standards of the typical American that would result if the government is more heavily involved in the economy.
Yeah, I think that is underappreciated point that most economists need to emphasize in any discussion is the alternative uses of resources. It is not costless, anything that we're pursuing. Specifically, politicians and policymakers love to pretend that there are no trade-offs.
Yeah.
And their policies can be costless and, just all win-win when we know that that's not the case.
Yeah, there are opportunity costs, right? They're real.
That's right. They are absolutely real. And I think that's just something that, it's not just about inflation costs. It's those real resource costs that needs to be kind of discovered and constantly highlighted and brought to light in order to make the general public aware of the real cost of pursuing these types of fiscal policies.
Yeah, I think we've seen these costs in the not so distant past. It always surprises me when people look at the period following the Great Recession. They refer to this long expansion. We went from 2009 to 2020 without a recession, and we only got a recession because of a pandemic, right? So this is billed as like a great achievement, no recession.
Right.
But we had pretty tepid economic growth in this period. And I don't think it's that the two are unrelated.
Right.
We had the Fed using these new monetary policy tools that involve reallocating credit, and it reallocated credit in no small part to the federal government, and we got relatively slow economic growth. So the analogy that I use when I'm talking with my students about this long expansion, I say, suppose that you had a daughter, and your daughter goes off to med school and she excels, top of the class, and she gets a great residency because, of course, she would. She's your daughter. She's brilliant, right?
Right.
And she finishes up. She has her pick of jobs, and she says to you, you know what I'm going to do? I'm going to work at McDonald's. Now, your daughter is exceptionally bright, and she will excel at whatever she does. And so, of course, she is excellent at McDonald's, right?
Right.
Every quarter, she gets a raise, right? 10 cents a quarter. I'm guessing that if you are hanging out with your friends at the cocktail hour, you don't look at them and say, let me tell you how proud I am of my daughter. She got a 10-cent raise every quarter. It's all growth. No.
Right.
You would be disappointed. And you would be disappointed because you understand her potential.
That's right.
And when we think about that long expansion, it's not enough to just look at those 10-cent raises. We also need to think about our potential, the economy's potential over that period of time. And from my perspective, I think that we were underperforming. We could have had a stronger economic growth in that period if we weren't so heavily involved, if the Fed weren't so heavily involved in allocating credit.
I think that is, again, something where economists do a great job of at least trying to communicate that it's the seen versus the unseen. And so what we saw was we had positive growth rates, but the unseen is, well, what could it have been, or the counterfactual.
Compared to what?
Compared to what, exactly. And you are right that, especially historically, you're looking at a lot of the innovations that took place over that time period. It's somewhat then shocking why weren't growth rates higher.
Yeah.
And so your insights there, I think, do provide some clarity. All right, it is October 5th, 2021. This is Claudia Williamson, and I am joined by Dr. Will Luther from Florida Atlantic University on the first Probasco podcast. Thank you, Will, for joining.
Thanks for having me.